All right, welcome back, everybody. Hope you guys had a good week. Let's go ahead and get ready to get started. Let's see, where are we? There we go. Let's get switched over to this. Okay, so, my God, this needs to go away. There we go. So, last week we began. Oh my God, can this?
Okay for you like that?
Yeah, that's fine. Why is this not? This isn't happening. Okay. There we go. There we go. Okay, so last week we were talking about some different type of accounts that we can own our things in, qualified accounts and non-qualified, the different tax benefits and things like that that you would be looking out for. We talked about some popular investment vehicles that we can utilize inside of these accounts, all of the super common things like stocks and bonds and funds and all that sort of stuff. We talked a little bit about investment strategies that you might see within the products used, index funds, which are mostly common picked things, super cheap, really simple investment strategy to understand. Passively managed, similar to index funds, but maybe with a little bit of extra pickiness about what's getting in there. And then actively managed, obviously, where you got a manager that's actively watching the market and attempting to create some extra return on top of what you can see in the market. And usually they'll call that alpha. And we'll talk about what that means later. We compared mutual funds to ETFs, just kind of the simple things to look out for and understand these two things, because they seem super similar, but there's just a couple key differences, like how the mutual funds are traded on what's called the primary market, where you're just dealing with the person who creates the product. ETFs on the secondary market, meaning you're sort of detached from that and it's trading between other people, other traders in the market. How capital gains get distributed out of mutual funds and how ETFs avoid that by, instead of buying and selling securities within the holdings, they're trading them back and forth with authorized participants. No intraday trading on mutual funds because you have to wait for the mutual fund to calculate the net asset value of everything that's in their portfolio at the end of the day, versus with an ETF. You're not necessarily buying and selling for net asset value. You're buying and selling for whatever somebody's willing to pay for that individual share. So that could be a little bit of a premium or a little bit of a discount compared to what's inside the holdings. You can go specific dollar amount holdings in mutual funds versus with ETFs, because it's standardized in the secondary market. It's only whole shares. And there's no concern about trading volume or availability of shares with a mutual fund versus with an ETF, because you have to participate in that secondary market. There's a chance that there's not a lot of trades happening, or that the spread between what somebody's willing to pay and what somebody's willing to let it go for is pretty wide. We talked about the three major indices that we use to compare ourselves to for the most part. Standard & Poor's 500, one that pretty much everybody knows about. The Dow Jones Industrial Average, one that's been around for a long time. And then the NASDAQ 100, which, as we know, is relatively more tech-weighted, just because that's what those top 100 companies are. So today, we're going to get started into the complicated and very specific and technical process of creating a portfolio. And we'll kind of simplify it in a little bit of a way and make it digestible and easy to work with, to where if you don't want to have somebody do it for you and you don't want to have to feel like a hedge fund manager, you can put together a decent portfolio. But also, if you have somebody managing it for you, you kind of have a vague idea of how to evaluate what's going on in your portfolio and kind of know that they're on the right track for you. So first, we're going to talk about new portfolio construction. And I kind of just generalize all of these terms into portfolio construction theory. It's just sort of concepts that we have derived from modern portfolio theory and our experiences working with our clients over the last few decades. So modern portfolio theory is a little bit more complicated. It's really the basis for how we measure the risk of a lot of the assets in our portfolio. And it's one of the main concepts and schools of thought of how we create it more efficient and make a better portfolio when adjusted for the risk that we're taking. So we won't dive completely into that, but if you're interested in how all this stuff works and where all these numbers come from, that would be an interesting thing to look into. And so portfolio construction theory is just the basis for how we select our investments. It's just like the ground floor, the foundation for how we're going to start choosing things. And it's a guideline to simplify portfolio building. Making an investment portfolio can be as simple or as complicated as you want it to be. If you really wanted to just make it really easy, you could use 3 to 5 funds and make a fine portfolio, and it would perform all right. You won't have as much control over individual positions. You won't be able to decide where to overweight and where to underweight, but you will be able to get returns that are fairly standard. And, you know, as long as you're taking care of your risk tolerance and your liquidity needs, you don't need to get too complicated to make a good portfolio. So, sorry?
What would you say those 3 were?
The 3 what?
If you invest in these items.
I didn't say anything specifically. I'm just saying if you wanted to, you could use 3 to 5 funds and make a decent portfolio. And yeah, so one of the main, one of the number one things that we want to use when we're creating our portfolio is time. We want to know how long do we need this portfolio to last? How long can we wait until we begin using it? All sorts of things. We just want to know how much time we have. How much time do I have to work with risk? Because the longer time we have, the more risk we can take. And I'll get into why that is the case in a minute. But if we have more time on the table, we can do riskier things because we're not concerned about the short time frame, about this year, next year, and the year after that. If we have plenty of years on our table, we can take greater risks because we will have more time for those risks to average out into a positive expected outcome. So the stronger our liquidity needs are, the less risk we can take. The more we need to be able to remove assets from the portfolio, the more we need that to be stable, because there is, like I mentioned before, it's kind of similar to the idea of having insurance on your assets. If you have a plan and you have like $1 million of assets that are supposed to provide for a certain thing or a certain income, and then it gets chopped in half by a lawsuit, obviously you have a much lower chance of that being a successful plan, or maybe it doesn't have a chance at all. It's sort of similar when it comes to investment risk, because investment risk, if you're fully invested in an NASDAQ fund or an S&P fund, there's a lot of volatility that's associated with that. Generally, it's from 18 to 20% from the mean return of the fund. So if we have a year where we lose 20%, that could be a pretty significant impact to our plan moving forward in the short term if we have cash needs. So if we have really strong liquidity needs, we need to take that into account when we're allocating our portfolio. So creating a portfolio at its most basic and simple form is a balance between liquidity needs and time. Those are like the 2 main things that we want to really pay attention to when we're creating our portfolio and when we're evaluating the risk that we're taking on it. So we have 2 different categories that we look at when we're creating a portfolio. The first one we call lateral integration, and we call it that because we're looking at time. We're looking at this horizontal bar of time. How long do we have on that? How far does it stretch? And that basically tells us what our risk tolerance is. You can also take into account the level of assets that you have and those sort of things, but time is the number 1 factor that's going to help determine what your risk tolerance is, because if we don't know how long we have, I can't tell you how much risk to take. Now, vertical integration is basically just managing your market exposure and your exposure to different kinds of individual risks. Because while there is just generally the risk of being invested in assets moving up and down in value, there's also more specific risks that we'll talk about that we want to diversify away. There are risks that are associated with particular companies. There are risks that are associated with particular countries. There are risks that are associated with particular sectors in the market. And those are things that, if we are able to control, we want to get them diversified away as much as possible. This is why, if you have a single stock portfolio, even if you stay completely in US stocks, but you just have 100 stocks instead, your risk goes greatly down on an overall fashion. Your market risk will probably stay relatively similar, but your company risk goes down by 100-fold, because now if one company fails, that's 1% of your portfolio gone versus 100%. So if we're looking at an example of liquidity, if we have, let's say we have an upcoming house purchase and we want to put down $100,000 on that. So we've got our bundle of $100,000, and our purpose is to purchase a house. We're assuming that this is going to happen relatively soon. We're not expecting that I'm going to save this for 20 years later and then we're going to buy the house. We're expecting that you're looking on the market right now. So we've got two different investment options. We have one that has a 95% chance of returning 3% and a 5% chance of returning 1%, which is pretty much like a money market fund. You can think of that as like a treasury bill or something like that. And then we have investment B, which has a 50% chance of returning 100% and doubling our money, but we also have a 50% chance of returning negative 50% and losing half. So in this example, which one would we want to choose? We want to choose A, because we don't want to get in a situation where I found the perfect house, it has everything, it has the pool, it's got the property, it's beautiful, it's in the community that I want, except now I have half the money and I can't afford it anymore. Versus, if we're in the other situation, we get paid a little bit of interest for our time, and it's better than just letting the money sit there, but we didn't take the risk of now not being able to accomplish our goal. So now we're going to talk about the law of large numbers. So what the law of large numbers is as the sample size grows, its mean gets closer and closer to the average of the whole population. So what that really means in simple terms is if you have something that you can measure on an average, like for example, people, if you have an average height in the United States, you might have, if you have a collection of 3 people, maybe none of them are that height. And one person's 4'11", one person's 5'6", and one person's 6'8", but really the average is 5'10". And if nobody matches that, that's because you have so few. But the more and more people from the US you add to that group, the closer the average of their heights will get to that measured number. So the place that this is most often used and is the easiest to understand is for insurance companies. If an insurance company is insuring you for something like life insurance, that's something that they can determine their risk pretty well, because they can look at general populations and they can look at what kinds of risks people are at. They can look at your lifestyle and they can use that to determine whether you're a higher or lower risk and if you're close to their customer that they want to insure. But if they're only insuring 5 people, that's going to be kind of tough for them, because they can't measure the average very well of that because there's so few people. You don't have enough data to give you a statistical number. But if they're insuring 1,000 or 10,000 or 100,000 people, they can make a much stronger guess of what, on average, the risk is going to be for each of those individuals. Yes.
Now, modern times, we're talking about climate change in Florida. Houses are probably uninsurable by now, but every year, a bunch of them get wiped out.
Yeah.
Wildflowers in the western states. Okay, that would be upsetting their timetables. Now, to me, that's okay with them, because they took the risk when they bought that house,
Mhm.
the mountain or at the beach. But now they're passing on some of those costs to us. You don't have those risks.
Right. So there's kind of 2 options that they have there, is if they're looking at, if they have this big sample size and now they realize that one particular portion, if you just break it down by states, now this one state has a much higher risk, they can either exclude that state from coverage to keep their numbers accurate and continue on with everything they have determined, and they would just have to exclude that from coverage and continue on covering everybody else as normal, or pass on those costs to everybody else, because now that affects the average and brings the average risk up. So that's kind of like the 2 options that they have in that scenario.
I've seen the insurance raise price a lot this past year.
Mm-hmm.
I don't think they can do the California market, or the economy of California is something like the 50 to 70 largest economy in the world. So I don't think they'll leave that good basket.
Right.
But they're gonna have to tweak it somehow. So us who are not, same housing in the same neighborhood, etc. People are starting to complain all around me, my neighborhood, about taxes. I have to talk to my insurance because we're not claiming anything and we're getting a lot higher.
Yeah, exactly. You can see the same thing in car insurance. So depending on what kind of car you have, your rates are entirely different.
Exactly. So,
Yeah.
So I'm wondering, what transpires by insurance companies in the next 2 to 5 years.
Mm.
When- 6 months in the next 4 or 5 years. Because obviously we're going to have changes.
Sure. Yeah, and I think that, well, I mean,
With these type of, when you're dealing with this type of theory, this is theory, then you put it in practice on, now you're talking something.
yeah, and I mean, again, that kind of comes down to why insurance companies will have different requirements of you to kind of prove like what exactly you are, where you are, what demographic you lie in. You can see the same thing in some like health insurance and life insurance when you need to get a checkup or something like that in order to get insured, so they know they're not insuring somebody who's terminally ill. So it's just, I think it's going to come down to them becoming more specific with what the requirements are for an insurable property. Either that or just rates go up. And that's kind of,
Wildfires. right?
Yeah.
That's the reason
Mhm.
why they're fixing our
yeah, absolutely.
public fire.
Yeah, and that's kind of how they protect themselves from not now suddenly having all this extra risk, because they just go, we're not going to cover something that is at greater risk for that particular tragedy. That's pretty common.
Then they perceive that the value of properties tiny because they're insurable.
Mhm.
So you're gonna start seeing, I imagine, mitigation of people from this kind of scary. I remember 10 years, 20 years, 30 years ago, going to Tuolumne and somebody did a town. And thinking, man, there's a fire here, they're gonna be jammed in because the roads are small and narrow, and twisted. Plus, at the same time, I remember noticing that a lot of the evergreen trees that there had a bug born from the plant. There was a lot of dead wood standing. And I saw this 20, 30 years ago, I said, there's not having a problem with it. It wasn't my problem, and I'm not in a position to deal with it. So I just forgot about it until it started to happen the last 10 years.
Yeah.
So there has to be changes.
Sure.
With this type of stuff, what you're telling me then is that they're gonna, instead of having big macro groups, you're gonna have micro groups. So they're gonna have to fine tune it.
Yeah, possibly. So just when you have smaller groups, because kind of your risk of not being able to measure it as well also goes up, because now you can't create, yeah, so you can't really get a strong statistical average because your sample size goes down. So then the premiums will start to rise with that as well. So if you have an insurance that's super particular, that rate is going to be higher. I mean, you'll see that like if you have like an insurance policy and now they suddenly drop the fire coverage, then you go to get that from somebody who specifically insures that, that rate's going to be pretty high. Sure, they can calculate the risk better because that's what they do, but it's still a smaller group of people in a smaller location. It's just not, it's not going to be on such a big sample size.
Say, which is the tipping point. And the earth is not able to replenish itself, because that's what all this people want is in my mind, also simplify it. It's just that the earth cannot replenish itself, so everybody's starting to die. But we're gonna have more and more of these situations of wildfire,
Sure.
droughts, super storms, etc., which then tells me in the long run, insurance will be very expensive for for the different people. Most people won't be insured. That should be the dynamics of housing.
The unfortunate thing is that wealthy people can't.
Yeah, I always have to include the wealthy because they're very different wealthy.
Right, but the insurance companies aren't gonna cover where that's the biggest threat, they just won't cover it, they'll drop people. My insurance went down $1,000 because my carrier found somebody else. And, but it started at about $1,000 a year and it's gone up 5 times, but the value of the house has gone up.
And the value of the house.
Yeah, so at the same time, if my house burns down, it costs a lot more. But if you have a house way up there, you're just not gonna have the coverage, or it'll cost you a fortune.
Yeah. So again, the more similar policyholders there are, and again, that's kind of why you have some restrictions on who they're going to cover, because they want all of their policyholders to be as similar as possible, because then that way there's less statistical risk for them in terms of each person all having this same thing crop up at the same time, because they can measure it on a grand scale. So the way that we see that in investing is we look at that for our return. So if you hear something like an index having an average return, like the Dow Jones index having an average return of 8.7% from 1998 to 2022, and this is measured by SPDR's ETF that tracks it. When you hear that average return, you might think, oh, cool, I'm going to get roughly 9% a year. And so I'm going to see every year, I should see about an 8 to 9% return. but that's not really how that's going to work. As you see on the column here on the right, if we're looking all the way down at 2012, we see, okay, 9.33%, that's close to our average. And then we get a 28% return, then another 9, then a negative return, 15, 27, -4, 24, and you just see all of these different numbers. But if you go and you take those and you average them together, that's where you're getting that 8.7%. So again, if we look at just a couple years, like if we were to park ourselves, let's say just right down here at the bottom, 9, 28, and 9, that's going to average a lot higher than 8.7%. And if we just looked at those 3 years and we go, oh my God, we got an average return of like 13, 14%, I'm going to invest everything in the Dow. And then you see you have a year where you actually lost 0.5%. Because that wasn't completely reflective. And then if you keep going further and further, you get more data in there, you realize the average is closer to 8.7%. Yeah, so if we were to go further back in history, you'd see some more greater negative returns.
Two negatives that bring the whole thing way down, but other than that, everything's above 8.7.
Right, and also this is from 2012 to 2021 versus this number over here is calculated from 98 to 2022. Yeah, so if we went further back, we'd see some more returns that would give us that average.
2022 was a bad year. We don't want you to have a stroke.
Are we, it's too late?
Yeah.
It's too late for you to tell me.
Yeah, but those are averages, 98.
Yeah. So we can see the similar thing here. If we look at, these are different types of assets. So all the way on the left, on the darkest color, you have small stocks. And then on the blue, large stocks. The brighter orange is long-term government bonds. And this darker orange is treasury bills. So you can see this pattern. If you see the different columns are representing 1-year risk, 5-year risk, and 20-year risk. If we're looking at 1 year on small stocks, we can make up to 150% or we could lose up to 60%. But if we simply have longer periods of time, that risk starts to come down a little bit. It starts to get closer to our average. Not that we get to low risk by any stretch of the imagination. Small stocks are still incredibly variable in their returns, but you can see we get down from this volatility of 150% to -60% versus if we get all the way to 20 years, we have all that data to average out. It's closer to maybe 25 or 30% and losing maybe 25% also. And you can see the same thing reflected through everything else. You see the same thing in the large stocks. You've got decent amounts of risk up and down on 1 year, but if you give it 20 years, that risk tightens up a lot. The returns tighten up too, but the risk really comes down. So how are we using this to our advantage? Well, we're going to hold our riskier assets for longer periods of time. Because when we have risky assets that can fluctuate up and down really far, but they have strong average returns over time, we want to make sure that we give ourselves all that time to collect all of that data, both the upswings and the downswings, so that we get that average. If we want to get an average of 8% or 10% or 12% on some growth fund, we want to make sure that we have enough data that's going to add up to that average. Because if we just give ourselves a couple years, we might get the worst couple years in the next 20-year period. And that would be really unfortunate, and then it would have been a negative thing. But if we get those whole 20 years, we get to feel the benefit of that average, and we get to feel the benefit of those upward returns over time. So we want to use less risky assets for immediate needs because we don't have the time to wait if the next year or two is really, really bad. We don't have the time to wait that out and let the averages catch up for us. We need to make sure that we are prepared to use those assets when we need them. And then we also just want to diversify. We want to stay across different types of assets. So if if we're all in small stocks, we might want to add a little bit of large or a little bit of international so that we have returns that go in slightly different directions at similar times. And then we can also use dollar cost averaging, which is really helpful. So dollar cost averaging, I'm sure a lot of you have heard of this before, but it's really just investing flat amounts of dollars at regular intervals, regardless of what the price of your investment is. So if we're looking at a stock, it doesn't matter if it goes up by 100% or down by 50%, we're always going to invest the same flat dollar figure at regular intervals continuing forward until we're fully invested. So this results in buying more shares at lower prices and less shares at higher prices. And that's good for our average cost, because if we have a downswing and we're buying more and more shares, that means that when things return back to a positive outlook, we'll have lots of shares to feel those gains going on the way up. And we're going to spend less money on those shares on an average, regardless of what direction the market moves. Now, if the market just tears upwards, it would have been better to just invest a flat amount and watch that rise. But generally, that's not how volatility works. And if you want to just feel a little bit more calm about your investing strategy, this is really good for making your emotions feel a little bit less severe. Because if you have $100,000 and you just shove it into large caps and then they go down for a few months, you might not like that feeling. Versus if we go in 10,000 at a time, you put in 10,000, you go, oh, it goes down, but now I can put another 10,000 in and get cheaper shares, and it goes down again. You get more excited rather than scared that your money is dwindling away. You kind of get excited at the opportunity, and then when you get to watch it rise, you get to see better gains. So dollar cost averaging is really not, it's not going to do anything crazy good for you. In the long term, it's not going to matter too much unless you're constantly putting new dollars in. But it's really a risk mitigation tool, so that if you're putting in a flat amount now, you might lose a lot. But if you're dollar cost averaging in, you're not taking on so much immediate risk. But when we get to longer periods, 20 years, 30 years, or however long, it doesn't end up mattering that much. So I wouldn't worry too much if you don't want to sit there and then wait a month I invest and then a month I invest. If you're okay with just setting your allocation and knowing that it's proper for what you need, that's totally fine too. So over time, this system could keep the average cost of shares low. Purchasing power has potential to be more efficient without the need for tracking share price and waiting for it to drop, which I'll tell you, most people do not succeed very much at watching the price of a stock move up or down and thinking this is a good time to buy, because often they'll end up buying when they see a surge in price and selling when they see it fall, just mostly based on emotions for the most part. But this allows it so you don't have to look at the stock price, you don't have to worry about it. All you do is, you're putting in your buy order when you put in your buy order for the amount of money that you want to. And if you see this reflected in both bear and bull markets, here we have a bear market where the price is consistently dropping. And you can see that our average price remains relatively low comparably, because when the price is higher, we're buying fewer of those shares. But when it drops to this really low value, we're buying a whole bunch more because we can afford it with the same dollar amount. And we see that reflected in a bull market as well. So even though you have some initial bearishness, and then it rises up and then it comes down a little bit and it continues moving, because we buy fewer shares up at the top, those are not skewing our averages super high because there's just fewer of them. We buy so many more of the cheaper shares that our cost remains relatively low compared to the market price for the most part. And you can see that in the bear market, we end up purchasing 102 shares versus the bull market 46, because as it goes higher, we're buying fewer and fewer of those shares. So when we look at time-based asset allocation, this is not definitive by any means, but this is how you can kind of visualize things in the most simplistic way possible. So these are not necessarily what you're going to choose for your portfolio. I don't always allocate a portfolio like this. If I have a growth portfolio, I'm probably not going to put much bonds in it at all and hardly any cash. But for the most part, this is kind of an easy way to think about it because we can categorize these assets pretty easily. So when we're looking at our short-term, immediate cash we need to access within the next few years, we want that to be in a cash asset. We want that to be in something that doesn't have a lot of downside risk. We want something that's going to pay a little bit of interest and it's just really going to pay us for our time. Treasury bills are a great example of this. Money market funds are a great example of this. And even commercial paper, which is kind of like the corporate version of a treasury bill, is a good example of this. And you can also think of this as maybe your savings account, like a high yield savings account that pays a lot of interest based on treasury bills and things like that. All those sorts of things are our cash assets and what we would want to use for a current expense. In the intermediate term, for a lot of people, especially just kind of the classical view of portfolios, we would use something like a bond. Now, when interest rates are shifting a lot, up or down, bonds can actually get pretty volatile. And we've seen that a couple times throughout the past, especially with long-term bonds. When we had that period where interest rates felt like they did nothing but go up time and time again, long-term bonds suffered really strongly. But for the most part, in the longer term, they are less volatile than something like a stock would be. So we might put a little bit of money into some bonds, some intermediate term, longer term, or just corporate bonds to get a little bit more interest than we would in a cash vehicle, but we're not taking risks like we would in the stocks. And then if we're looking at long term, we got plenty of time. We're willing to see downturns. We're willing to see companies rise and fall and do all sorts of stuff. That's when we're going to choose these riskier assets, because we are willing to let them sit there for longer periods of time, and we're willing to allow those averages to accrue up and get closer to that average return that we see based on historical data.
If that was the first long-term.
Sorry?
People who long-term stuff, the home.
It kind of depends. It also depends on what kind of stocks we're talking about, because we can go all the way from a large cap value stock, like I don't know, it's just a big company that pays solid dividends, that's pretty stable, all the way down to a small startup stock that is just getting off its feet.
I'm just wondering.
Yeah.
So, when you tell me all this stuff, things that.
Definitely. Yeah, we'll get into some of those numbers later, but I'll give you just kind of a rough idea. For short term, generally I'm thinking within the next 3 years-ish is kind of like how I like to look at that. And intermediate term could be maybe from 2, it also depends on your situation, like what is considered long and short term, but intermediate term could be anywhere from 2 to 3 years up to maybe 4, 5, 6, 7-ish, a few years. And then long term, we're thinking 7+. Anything beyond that period, really or really long term, I'm thinking 10 years and more is where I'm willing to just take all kinds of risks and really just push it. So, yeah, a lot of it does have to do with your age. So here we've got a risk tolerant spectrum of different types of assets. Based on what we've already talked about, this will make sense. But if we look at we have low risk and low potential return, and high risk and high potential return at the top. So all the way down at the bottom here, we have our cash and cash alternatives. Super low risk, super low potential return. I mean, you buy a treasury bill, you're not going to make much more than 5%, and that's if you hold it for a whole year. But if you move up to other government bonds, longer term bonds, you might get a more decent return. Like, for example, if you're holding a long-term bond right now and and interest rates start to drop, then the value of that bond will go higher. Same thing with corporate bonds. You might have a company, and let's say their credit rating gets increased. They're now a more reputable company and they're more able to pay back their debts. Now the bond that you have has an increased credit rating and it's more valuable. There's just other factors that start to go up. With the US government, we assume that the credit rating of the US government is better than anything you can get in the open market, because theoretically it'll never default. Now, you might have your own thoughts about that in the future, but that's kind of just what we assume in the investment world, because if they really look like they're going to default, they'll just, print some more money to pay you back. So, regardless of what you think about that, that's kind of how it manifests itself in the investment world. Then we get up to large stocks, which are kind of in that middle ground where we have a decent amount of risk, but also a decent amount of potential return. Getting up to internationals is also higher. However, international returns can kind of lag behind a little bit. They're not quite as good as US equities are for the most part. And then you've got small stocks all the way up at the top with the highest risk and the highest potential return. But again, when I'm comparing small stocks and international stocks to large US equities, the trade-off just is really not the same. It's not quite as, they're good to have as little different parts of your portfolio, but I just still bias mostly to large cap equities, whether it's value or growth, just because on the long term, the returns for the level of risk that we're at proportionally just generally tend to be better on large caps. That's just kind of how it is.
International. You're allowed to buy Chinese.
So we aren't going into individual stocks, like individual Chinese stocks, but we can do something like a mutual fund or an ETF where they have their vehicles to hold the foreign stocks.
You're not individual. Can't buy it. Good move, investment.
So I'm not sure if you can't, you can.
Chinese stocks.
Yeah.
Buy individuals.
Yeah.
Yeah, we don't buy individual stocks because the risk is high. Buy the wrong one, people out of business and then that. We have a fund that's ex-Chinese government that does businesses that aren't affiliated with the government. But primarily, he'll use a broad base of international because you don't know what political problems you can run into in one particular company. And the past is never the future, ever. So if the Chinese stocks did great or not, a lot of that's based on politics. So what he's doing is engineering portfolios that have market average. So you never regret, oh no, I bought that one point and it's down 50, 60.
Well, I'm only thinking two things. One, you find more risk and then more retirement care. But then,
No, not necessarily.
but not necessarily.
Yeah.
And the other thing is, it's almost like bidding against your own country.
Well,
It sounds like the Chinese, or people say the Russians.
Yeah. we don't mess with that because look at what happened to Russia. You had stocks and currency, things that crashed at that point. So we won't do that. We'll do more of a total international. International stocks are good because their price earnings ratios are lower and the price is lower, but they usually don't bust out and grow like US stocks. And you want to have some international give you better value, but they might not never take off like some of our growth stocks do. It's a good balance.
Yeah, and the other thing that we use international stocks for is it's not necessarily going to make our returns better, but you can kind of think is if you have your US stocks and you have your international stocks, and if you have a little bit of liquidity needs, you know, maybe you're taking RMDs or something like that. One thing that they're good for is you might have a year where US stocks do poorly and internationals do well. Okay, okay, we're back. You might have a year where US stocks do poorly and internationals do well, and it just sort of it kind of buffers the loss of those US stocks a little bit, just simply because they tend to move in different directions. So you might have some years where you want that overall risk that at any period of time your loss might be cushioned a little bit by those assets moving in different directions, just so it's not like, because if you're 100% in US stocks, you feel the full weight of that decline, versus if you have some bonds, you have some internationals, maybe you have some smaller companies or specific sectors, that one chunk of your portfolio might dip in value, but other things might compromise for it a little bit, and internationals tend to move in different directions than US stocks overall.
Internationally, we're more.
Yeah, sure. Mhm.
It gets to a point where you don't want to widen the pot in certain areas like the Russians.
Yeah.
The Chinese.
Yeah, and that's why we'll have funds like he was mentioning that are kind of X this country or X that. So like if I'm doing internationals, usually what I'm doing, because I'm not trying to pick and choose too much, is I'll do like a global fund X US. So it only excludes US and then includes everything else. But if you have certain moral objections to certain countries, there are lots of international funds that will exclude certain countries, or you can just pick ones that invest in particular ones that you do want to support and just have a collection of that.
I think that companies, products, everything.
So they're more of American.
Well, they're American, but they can be doing business all over the world.
Oh, yeah, I understand Coca-Cola,
Right,
but still it's based on the line of Georgia.
right. But the main thing is the lower price earnings ratio, they're more valuable, they haven't taken off, they're not going to take off in a big way. Currencies also, if our currency drops in values, they go up, you get a little bit. And you can hedge some portfolios, right?
Yeah, sure.
And the other side of that is foreign company investing.
Mhm.
Because I'm sure there's some stuff that foreigners, especially they got big bucks, and they do their measure for the world. They might be investing. I know a lot of foreign elected finances because of this stability and growth stuff, which is probably what you take. Am I wrong in assuming that was growth stuff?
It is the pretty big majority tech. Yeah.
Well,
The emerging markets are also interesting at times. We keep thinking they're gonna take off and they don't, but they don't tend to get into the debt levels that we get into. Time to our debt is a concern. Emerging markets might go better because they're not that big. But you're always gonna know this after the fact.
But then you read the politics, and you know Argentina, I think it was Argentina, has defaulted under the.
That's why we don't,
under the number of
we
times.
don't encourage individual countries.
No, I understand, but what I'm saying, that is where you have to look at the past, is
Absolutely.
to get an idea of current risk. So in countries like Argentina that have defaulted on their debt to the taxes, I'd be very good at Argentina.
Right.
And then you look at some countries, continents like Africa, they keep on saying Africa's gonna come up, Africa's gonna come up, and it hasn't come up yet, but we're talking about like some.
Yeah.
You kind of wonder about that too, but obviously it's a different ball of wax.
Right, you probably want to manage fund at that point with somebody that knows what they're doing. Okay.
So now we'll move on to the idea of diversification. And really what diversification is trying to do is minimize exposure to any individual risk by combining multiple assets of different types and exposure in the portfolio. Because we don't want to be in a situation where our entire portfolio is, I don't know, technology or utilities or energy. For some reason, if you have an entire energy portfolio and the price of oil just falls through the floor, you're probably not going to be too happy about it. And the rest of the market might be doing okay. So what we want to do with diversification is really just any of these individual, really particular risks, we want to diversify so much that they pretty much go away statistically. They won't go away entirely. There will always be a little tiny bit of your portfolio, but it will be to a point where it just doesn't even matter, that the yield on a treasury bill will probably make up for it. So when we're just talking about stocks individually, this is kind of that concept I was talking about before. When you have one stock in your portfolio, you've got two components of risk. There are others, but we're just going to focus on two right now. One, you have the market risk, which is shown in green and is the same in all of these different versions of the portfolio. But then you've got company risk, which is shown in yellow. When you're all the way down to one stock, you have the most company risk possible, because if that company does bad, you do bad because you are 100% in that company. And then if we move to two stocks, that comes down a lot, but it's still really high because one company fails, there goes half your portfolio. We get to 4 and it drops, 6 and it drops, and it really starts to become almost negligible when you get to 50, 100, or 1,000 stocks in the portfolio. And when you're picking like a broad market or an S&P 500, you're getting to these numbers. You're getting here or even greater. And that's what we want to see, because we don't want the risk of a particular company dragging us down really hard. So there's a lot of different types of risk that we want to diversify from. We've got two broad categories when it comes to risk. We've got systematic risk, which is non-diversifiable. That means that it doesn't matter how many different stocks you own, you can't get rid of this. You can't make it so small that it's negligible, but you can manage it. So there are things we can do to adjust how much of that risk we're exposed to, but we can't diversify it away. Versus with unsystematic risk, that's our diversifiable risk. That's the risk that we can pretty much eliminate from being a major concern of our portfolio. So we'll talk about those first. You have accounting, business, which kind of are the same, executive, financial. All four of those kind of mean the same thing. It's just the company makes really bad decisions and then everything kind of falls. So you've also got country risk, which is something we were just talking about, where an individual country could be doing horribly with their debt. They could just, like, that country may just fall down the drain. Even if the company's really good, the country just kind of, goes downhill, and that investment might not be worth so much for currency reasons, debt reasons, all sorts of different things. You've got default risk, and that's usually in terms of bonds. So if we're looking at a bond from a corporation and they have a really bad credit rating, they have a really horrible history of paying back their debts, there's a much higher chance that you're not going to get your principal back. You'll be getting your interest, and then one day, now your money is just not coming back. So you put your $1,000 in, and then you realize that company's defaulting on this loan. I'm not getting this investment back. It's pretty much the same as a stock going worthless. So that's something we want to avoid. And usually what you'll do is have lots of different types of credit ratings, lots of different companies, but also just have better quality bonds. Having low quality bonds is fine to increase a little bit of yield. You just got to understand how much risk you're taking on. And if you're going to do high yield bonds, buy a really good ETF or mutual fund that is well rated and decently cheap and is really well diversified, because default risk, again, it's just like the risk of a stock going completely worthless, just drying up and disappearing. And then you have government and regulatory risk. For the most part, we're concerned about this in sectors like possibly green energy or your regular energy, where if regulations were to come out and say, now we have to do all green energy, your oil production companies are not going to do so great because they're not going to be able to do business. Or if nothing ever happens in that direction, your green companies are just going to kind of fall off the face of the earth because at the current moment, they just simply cannot compete. They are not as efficient with what it costs to create the same amount of power, and they just cannot create the same load of power. They can't support the same demand that the country has. They can support little areas, but they won't be able to take over that market share until things get more efficient and they can really provide the same amount of energy. So that's something to think about when you're looking at different sectors. That's where that mostly comes into play. And when we're talking about systematic risk, these are things that, again, we can't really get rid of, but we can be mindful of. Purchasing power or inflation risk is just the risk that the dollar gets weaker as time goes on, as it does, because that's what inflation is. And it's really just thinking about how strong is that inflation rate and how am I combating it? Usually by having growth securities, that's how you're combating inflation, because if you're returning 8% and inflation is 3 to 5, you've got a little bit left over and you might not have quite as much money as you thought you did because it buys less, but you're still keeping the pace and you're still able to, do what you want to do with those dollars later. Reinvestment rate risk is the risk that once you have come out of an investment, usually for bonds, once your bond matures, the risk that you're not going to be able to get another bond at that interest rate. So right now, we might be feeling a little bit of that risk. If you're in a long-term bond right now, you don't want to get out of that, because if you get into short-term bonds, those rates are going to start falling. You want to hold on to that bond that is paying you a solid amount of interest, because you don't want to lose out if you're getting 5% or whatever it is, and now you go to buy a new bond and it's like 4.5 now. That little 0.5%, that's a risk that you're taking. You just are not going to get that. And then interest rate risk. Interest rate risk is in the same vein as reinvestment rate risk, but it's a little bit different. It's the risk that the interest rate that you're getting right now if interest rates rise, now your bond is not worth so much, because nobody's going to pay the same price for your bond as if they could just go and buy their own, and now they get more percentage than you do. So if the interest rates rise, now your bond is worth less. But if they fall and you're still holding on to your bond, you'll see the value increase. So you might get a little bit of extra return on that. And so the way that we manage interest rate risk is by looking at what's called duration in our portfolio. We'll talk a little bit more about that specifically in a bit, but duration risk at its simplest is just looking at how long our bond is, the maturity, and how much interest we're receiving on it. It's kind of a function of those two things put together. And what your duration risk is basically an idea of, if interest rates move by 1%, how many percent is the value of my holdings, of my bond holdings, going to change? So if you have a duration of 5 and interest rates go up by 1%, you're probably going to lose 5% on your bonds, just because they've lost a bit of value and nobody's going to want to pay for that. Exchange rate risk is kind of similar to your country risk, but it's more specific on the rate of exchange between the two currencies. That's something that you can't really get rid of besides just having a lot of different countries within your portfolio. But the only way to really avoid it is to not invest in foreign countries. And then you don't get that diversification. That's something you can decide on. So how are we addressing these risks? With systematic risks are non-diversifiable risks, the ones where we can't get rid of them, but we can manage our exposure to them. We want to manage exposure and allocate position categories based on time. It's just one of those things where we're going to see these risks pop up in our returns. We're going to feel the effect of them at some point or another. But have we allocated to a point where that's not going to matter? If we allocated to a point where, sure, we can feel a lot of market risk, we can feel investments going up and down, but we've got plenty of years to where that's going to average out over time and it's going to be a positive number. For our cash positions, is our duration low enough to, even if interest rates go up and down by a whole lot, our holdings are going to stay relatively stable and they're not going to lose a ton of value before we have to liquidate them? With unsystematic risk, or diversifiable specific risks, break down your allocations into multiple specific assets with different underlying holdings. Now, if you're using index funds, this is pretty easy because they do it for you. If you're holding a broad-based index fund, that's enough stocks that you're not going to be worried about company risk. You're not going to be worried about executive risk or any of those other things. You're really just going to be worried about the actual market risk and the statistical risk of being in the US market. So again, with all those different types of unsystematic risk, there's these four here: accounting, business, executive, and financial, which are kind of all similar versions of a type of risk. Is you just don't want to put all your eggs in one basket. You don't want to rely on one company to give you your return. You don't want to rely on one specific company or executive or anything to make sure that your portfolio does well. Get diversified across companies. Allow multiple different companies to succeed for you rather than just putting all of your eggs in one basket. With country risk, diversify among those foreign countries. Make sure that you're not overexposed to India or China or any place, it doesn't matter. Make sure that you're not overexposed to that specific one. The US markets tend to be some of the most stable and most, like, I don't want to say predictable, but it's just sort of, they have these similar, lots of volatility, but also lots of growth. It's where you're seeing a lot of companies succeed. So it's not as much of a concern, and it's just like the biggest stock market that you can be in. So there's a lot of ways to diversify inside of there. And plus, if your currency is the currency of the market you're invested in, there's not that exchange rate risk because it's the same dollars for dollars. For default risk, manage the credit rating of your bonds accordingly. Make sure that if you have some bonds that you need to get access to, that those are highly rated, AA, AAA, even single A is fine. But make sure you're not dropping into the double Bs, single Bs, Cs, or worse. We'll look at that a little bit more later. And government and regulatory, just make sure you're diversified among the sectors. Don't be too concentrated into one particular sector of the economy, because then if regulations change, that sector might be toast entirely. So managing systematic risk. When we're talking about purchasing power, just don't leave your cash in cash. If it's going to sit there for a while, don't let it just lose value to inflation. At least put it in some treasury bills or money market securities so we get something for our time. Don't let it just sit there and get eroded by inflation day in, day out. With reinvestment rates, when you've got a really good rate, you can lock it in. And sure, you might lose out a little bit if interest rates go higher, but then if rates go lower, you're not gonna, suddenly be beholden to that. Sure.
You can sell T-bills at any time, right?
Yes.
Yeah.
Yeah, pretty much. Yeah. And also pretty much anything that has a maturity of less than a year, we consider cash because it's relatively liquid. And that's sort of what 1 year is what's considered a current liability or a current expense or anything like that. So anything under a year is considered cash. But yeah, you can buy and sell treasury bills very easily. And you can also just get ETFs that will roll treasury bills inside of them. Like the one that I'm using right now is SGOV. It's 9 basis points for the management fee, and I think it's getting a yield of 5.2%, which is pretty solid for me. So that's what I'm using for cash positions and accounts right now.
I confirmed that what the ETF does allow you to get it state tax free.
Hmm.
So if you have a fair amount of money, it's a good idea to do T-bills, and if you want an ETF, there are a couple that pass that state tax free benefit.
Is it better to have the ETF or just keep your T-bill? Find something.
I don't think there's really too much of a difference, to be honest with you, especially if you get something really low cost and you're only giving up the tiniest little fraction of the yield. I don't see what the reason would be for you to want to sit down and make sure that you're buying and selling T-bills over and over again. You might as well just let somebody do it for you at a low price. That's just my opinion, though.
Yeah, because you don't have to keep redoing it, right?
Mhm.
Just leave it there and let it roll over. And it'll roll over within a month, each month, or 3 months, or so on.
Yeah. Now, if you want control of the length of maturity of the T-bills, that would be something to consider. If you want to make sure you lock in a year's worth of those yields, then you might want to buy them individually because you don't know, you want to check on how the ETF is managing that. The one that I mentioned is 0 to 3 months. So they're not locking in a full year. They're only looking at 0 to 3 month T-bills and constantly rolling them over and over again, versus you might have a 1 year T-bill ETF that is buying them 1 year at a time.
BIL, isn't that iShares T-bill?
BIL, yeah, I don't think it's iShares.
Are they short maturities or are they?
Well, I think there are longer maturities. Not sure. I think it was 0 to 1, so it's some of the short, some of the long. Yeah, it kind of depends. Yeah. Again, those are going to be very similar there, because a lot of the times what the money market funds invest in are treasury bills. So they'll be getting their yield from that.
Their yields will change daily.
Yeah.
Whereas a 3-month treasury ETF will hold it for 3 months. So good or bad, the money market is kind of fluctuating.
Yeah, they'll use, it's pretty much kind of similar, but they just use a lot of different instruments. So anything that is within that 1-year maturity can go into money market, commercial paper, treasury bills, all sorts of things. Any of those super short-term debts, they'll use a combination of those to generate short-term yield. Yeah. It is pretty much a bond. I'm not too sure about the specifics of it, but yeah, it's kind of like the corporate version of a treasury bill, pretty much.
The
Yeah.
banks will negotiate deals with companies on a short-term basis, and you'll see them in what's called a floating rate fund. And its rate is usually much higher, but they're lower credit rates that the banks are lending to small business.
Can you buy the mortgage from the top?
Yes. Yeah, and they all, iShares and T. Rowe Price, everybody has a floating rate fund. But be advised that it's a low credit rating. There you'll have a lot of triple B bonds in there and Bs in there. That's why it's earning 7.5% when most everything's earning 5%. There's always strings attached to everything. But they've gone up a lot in value because we were using them when interest rates were higher. Now that interest rates have fallen, our short-term bonds have gone up 7.5%, but only 5% of that is yield, and the other 2% is popularity. And people want to lock it. So floating rate is great, but it's like a high yield jump bond on a short-term basis. Interest rates won't affect it because everything's short-term, but credit ratings, like you said.
Yes.
Finding measuring risk on a short-term basis is very difficult.
Sure.
What on the indicator side, you look at is the VIX. Do you look at any other indicator beside the VIX?
Yeah, so to be honest with you, indicators like that are difficult to use because again, that's a heavily sentiment-based indicator in a way, because like they say, it's the fear index. It's kind of it's a lot of the sentiment, it's measurement of sentiment of what's going to happen. And honestly, like sentiment mostly matters for retail investors, which is not a huge portion of what's in the market. So again, it's just something that we don't really look at because again, if I'm going to look at a short-term need like that, I'm not going to use something that is going to have a greater level of risk that I would be looking for other indicators for. Because when you get to that point, you're kind of looking at tactical positioning versus just strategic long-term, like low maintenance planning, versus that's a little bit more of a tactical investment approach, which is not something that we employ for the most part. So when it comes to market risk, you can't really get away from market risk. It's something that's going to be there regardless. It's just if you're invested in a market, there's going to be risk for that market. So you just want to allocate with time in mind. When you have that higher level of market risk, which generally when I talk about market risk, I'm thinking of standard deviation, just fluctuations up and down. You just want to make sure that when you have higher risk, that you've got more time to feel that out. And if you have less time, you crunch that risk down to a lower value that's not going to be fluctuating as much. And then exchange rate, just make sure you diversify among those foreign countries. Now, we'll go back and we'll recap this a little bit because I know that's a lot of information to take in all at once. So let's just go back and kind of slowly go back over anything. If you have any questions, now would be the time to ask them. So going back, looking at the beginning of our new portfolio construction process, we're looking at lateral integration, which again, if you remember, it's looking at time. It's looking at time on a horizontal basis and thinking, if I have less time, I take less risk. And the further and further I move, the longer periods of time I have, I take more. And we start to segment those. You'll see later as we get into actually building a sample portfolio that we'll start segmenting these portions and we'll have different types of assets for each location. So you might have like we were talking about those time frames, 0 to 3 years might be that first section. You might be looking at your RMDs coming out, or maybe you have healthcare costs that are continuous that you're looking to pay out, or you're looking to take a vacation next year, or anything like that. And we're going to be putting things like in treasury bills, in money market securities, and super short-term corporate bonds, anything like that. Ultra short bonds are our most favorable position for a lot of this when you're not looking for straight up T-bills or anything. And then you're moving forward and you might even be getting into a little bit of equities or longer term bonds. Yes. So ultra short bonds will generally refer to bonds that mature 0 to 1, maybe 2 years-ish, sort of in that really short period. You have short term, which is generally maybe 1 to 5, 0 to 5, somewhere in that range. And then your intermediate terms are beyond that. Longer term generally refers to 10 plus. So that's kind of long term 10 plus, intermediate 5 to 10, and then short term 0 to 5, and then ultra short kind of in that 1, 2, 3 sort of area.
Vanguard has an ultra short term municipal lot, federally tax free. That's nice if you don't want to buy tax. But it can fluctuate up or down 1% of that.
Yeah, so again, you might get into a little bit of equities or those longer term or intermediate term bonds in that middle area. And then as we get to the end, we start to get as risky as we want to be. If you want to have individual stocks, this is where you'd put them. If you want to have small stocks, this is where you'd put them. Any of those really risky things, that's what you're going to put in that longer term. And then we started a little conversation about diversification. And this is where we started talking about those different types of risk. And we'll talk about why we have a pyramid shape a little bit more next time. But to give you just a little bit of an idea, we want our biggest positions to be our most diversified, our broadest, our lowest cost, simple stuff. Think index funds. That's what's going down here. And then as we move up, our positions start to get a little smaller and they can get a little bit more specific. Think factor funds, or maybe managed growth funds, or anything that's a little bit more specific. Sector funds that are still sector indices, but they're not quite particular and they're not completely broad-based. And then we move up a little bit more, we get to the top, our smallest positions. That's where individual things would go, individual stocks or bonds or treasury bills or whatever. Your super specific, maybe tech funds that you like, maybe a T. Rowe Price managed fund or something like that, where there's a lot of active trading. Any of those really particular and just things that are going to start to have more of those diversifiable risks. When those start to pop up, we want those to be smaller positions of the portfolio because we want it to still be a small drop in the pond of our whole portfolio that is well diversified by cheap index funds for the most part. So we talked about, again, that lateral integration, using our time horizon to dictate our level of risk. And yes, value of assets can be important to that because you might have way too much money and way too much time. And you just think, well, I could take a whole bunch of risk if I wanted to, but I could also just let this generate a lot of income and live on the income and that would be fine. So you kind of got to think about what is your particular situation. But for most people, time is going to be a big factor in what your risk level is. Because if you've got 20 years, if you've got 30 years to wait, you can put a lot of really high risk equities and let those average returns show up for you. And then you'll be able to see that positive outcome at the end. Day-to-day positive and negative returns statistically average out to your positive expected outcome. Like I was talking about, that's that law of large numbers. That's that understanding that a day might be a positive 50 or a negative 30, but the average at the end of 10 years, of 20 years, of 30 years could be 5, 6, 7%. And that's what we want. We want to feel enough of those days to get that average. Now, if you're lucky and you happen to participate in all the best days, good for you, but just don't expect that that's going to be the reality forever. So we're risk off for liquidity and risk on for growth. If we've got time and we're willing to grow these assets and that's what we want, that's when we take those risks. But if we need the cash, if we need the capital at any time soon, risk off, just a little bit of interest for our time is what we want. So asset class returns. This is an interesting little slide from Morningstar. I like these Morningstar presentations because they really graphically show a lot of things. So highs and lows, so what we're looking at here is we've got our highest return, our lowest return, and then they put a compound annual return in the middle, which is basically like if you looked year over year, what would have been the return that you would get the same of every single year to end up at the value at the end. So with small stocks, we saw that the worst return was negative 58% and went all the way down to almost minus 60. If your portfolio was in that, that would have been a really unfortunate time period for you. But it also went to a point where it was almost at 150%. It went to 142.9. But then if we look at the period from 1926 to 2022, every single year, the compound annual return was 11.8. That sounds a lot more calm than going all the way up to 150 and dropping all the way down to -60. So that's again another reason why you should think a little bit more in context of when you hear an average return or a compound annual return or an annualized return. It's going to be a factor of all these different variations. So moving over to large stocks, we have a high of 54% and a low of 43.3, but the compound average was 10.1. Long-term government bonds all the way up to 40. So that must have been a point where you were holding long-term bonds and interest rates dropped really low. But then you also have the period where interest rates went up really high and they went down by 26%. But their compound annual return is 5.2. Intermediate term government up 29, down 9.5 with a compound of 4.9. And treasury bills, because they don't move a whole lot, their highest point was 14.7%. I don't wonder what happened to have treasury bills go up 14%.
78. The home mortgages were 60%. And we had, I had Oppenheimer money market fund paid 18%. People said, okay, I love that, but I'm gonna go buy a T-bill at 20%. And they all were short-term and changed. A lot of people went to Mexico saying, I did 25% there. I'm not gonna mess with 18% on this Oppenheimer money market fund. And they got 25%, and when they took the money out, they got it in pesos. And they dropped 50%. So there's no real gain. It's all about
Yep.
time. Yeah, time. But that was when interest rates went through the roof, as high as they did a few years ago. The bonds dropped 50% temporarily, but the good
Yep.
news back then is the rates fell back down and the bonds recovered. The problem 2 years ago and why we didn't have long-term bonds as rates went up, they haven't recovered, and so they're not going to get that value back on long-term.
Right. And then again, as you might expect, the treasury bill compound annual return about 3.2%. So kind of a cash vehicle. And we talked a little bit about vertical integration. We talked about systematic risk, how that's our non-diversifiable risk. And really, that's what we're using lateral integration to address, is the systematic risk, is the idea of how much risk are we going to take on of that non-diversifiable risk that we have to feel in order to get any growth. That's managed with proper asset allocation and lateral integration. And unsystematic risk, all of those specific little things that could happen to any individual company, country, anything like that. That's what we want to diversify. It's security specific. And we manage that with a broad selection of different securities, things that are different from each other in different sectors, that are managed by different people in different places that do different things. If we're diversified across that, then one major event will not take our whole portfolio down unless it takes the whole economy down, in which case we have other problems. And again, sort of re-emphasizing that stock diversification idea. And you can think of this with all of the other kinds of risk too. I mean, you can think of this with interest rate risk. If you have only like super long-term bonds versus if your duration gets shorter and shorter, that risk comes down. It's just really diversifying or managing those risks in different types of ways, making sure that you are not overexposed to any one thing. Because again, if you're just sitting in one individual stock, that company holds all of the power over your available assets. Versus if you're diversified between 1,000, that company could go up in flames and we would not care at all. It could just vaporize and you wouldn't even notice. You just lose one position in your portfolio. So with that, questions or comments, anything you gotta ask or say? Well, with that, we're a little bit early, but I hope you learned something and I hope that was useful. So if you have anything, what?
The pyramid, when you say index funds at the bottom, which ones, can you give us a little insight of what you like down there?
Well, again, that's going to entirely depend on the portfolio. So if we're talking about just kind of a regular balanced portfolio, we're usually looking at S&P funds and stuff like that. Something like SPLG or VOO is Vanguard's S&P fund, super inexpensive. Yes.
BTI.
BTI, I think that's their total market, right? Yeah. So when we look at total market versus S&P, we see the returns to be almost the same. So for me, when I'm building a portfolio, total market and S&P, again, they kind of accomplish the same things. But usually when I'm building a portfolio, the only reason that I would pick the S&P versus the total market is because somebody's going to recognize that. and then go, oh, okay, I'm in the S&P 500. That makes sense. I understand that everybody invests in that. But if you feel at all better about being diversified that way, that's great. However, one thing to keep in mind is because of the way that bigger companies take so much market share, it ends up weighting so heavily to those 500 stocks anyway, that all of those other companies that are in there, they could go in any which direction. It could go up by 1,000% and it wouldn't make any difference at all, just because of how heavily weighted everything is in those S&P 500 stocks. I mean, that's kind of one thing, like we used to talk about how, oh, you can get a total market fund and it'll be a little bit calmer, more diversified. And we look at the charts and we go, it's the same thing. They move in the same direction because of how much weight those 500 companies pull, and really more like the top 10 companies pull. They just move the entire market in that way in the US equities market.
Yeah, this is a time that if you have growth funds that have a lot of tech stocks in it, NVIDIA usually ends up being one of the biggest ones. And then its two customers are Microsoft and Apple. Well, those are going to move together. We have a big downturn. You're going to see a huge decline. So if those have done really good, a growth fund or individual growth stock, tech stocks, it's nice to maybe move some of the profits over into something that is down. And you would think small caps are high risk, but the market could crash and they might be better because they haven't been driven up, or they do pretty well. If interest rates come down, small cap companies do well because the cost of borrowing is lower and easier. Big companies can get all the cash they want, but the little ones can't. So trying to predict this stuff is impossible. You'll always think, what the heck happened? So the models that Nash is working with are averages and engineering, kind of like building on in Tahoe, but then it didn't snow for 3 years. Why did I do that? Well, because one of them one time well. So
you have to be in the right place at the right time.
right, yeah,
So small caps are a bit riskier, right?
yes.
So you have a smaller number.
Yeah.
And the term risk is relative. If you have a broad market small cap index fund, the risk of loss after 7 years, let's say, is very low. But within 2 years, it's very high. So if you put this out further out there as small caps, because small caps might be safer today, if you get in today, than large caps. We don't know that in the short term. The long term, their average volatility is more like what, 35% versus.
Yeah, small caps generally 25 to 30. Large cap growth is like around 20, sometimes up to 25, usually like 18 to 22. And yeah, that's kind of where you're at.
Dollars on the sideline. I hear they say the mid cap stocks, maybe mid cap value might be a sweet spot, but I say might, because then if everybody goes for the large caps and they ignore those, they can fall. The thing to remember is the value of stocks are what they earn in the long term, right? How they're productive and things. But in the short term, it's an emotional line. And so if you want to get a good purchase, it's always a bad hold. Because somebody else bought it at a higher price, it's dropped, it's a bad hold for them, but a good purchase for you. So you have to go the opposite. So what we had recently mentioned a year or so ago, we talked about utilities as a small sector position because they were down 15%. Now we're up 35, 40%. So we've taken a fourth with some accounts, depending on the time frame, and bought into a real estate fund simply because it was down. It's a lousy hold, but a good buy. And now we're up 16 or 18%. But that was not predictable. It was just, this looks like it's pretty high. Because Nash has a list of things to do daily, weekly, monthly, and so on. And it was time to look at the sectors that had outperformed their normal history and maybe be suspicious of that. And we all remember why utilities have gone up higher than the stock market. Remember that conversation? Why did they go up? Why are they up higher than the because of NVIDIA and tech stocks. How would that help utilities? How, right? Everybody's freaking out about we've got to do that. Then the real estate fund that we bought into was down 16%, now it's up 8%. Because they're buying data centers and real estate and towers and things like that. The next thing might be energy was down, but it's up this month. Maybe alternative and regular energy is going to go up because they have the power areas to power the data centers. But we don't know that. You know, I wish I could say that we knew that, we predicted it, but it was just made sense to reallocate a sector that was up way too much and move it into something that was way down. way too much, and then we happen to get lucky. And, but if we knew that was gonna happen, we would have done all the money there, right? But we already did 5 or 10%, so you're never gonna hit it right up to that.
So you think that like a factor.
Yeah.
60.
Yeah.
Where would you find the performance of the different sectors? Where would you go?
So let's see, I forget exactly what it is, but there is, I think it's SPDR. I think they have like a nice little grid. Let me see if I can find that really quick. Trying to see the performance of the different sectors and how they're all doing. Let me see if I can find that.
Their SPR, Standard Force Depository Receipt, used to be the first time. You got a depository receipt that represents 500 stocks. But you'll see them advertising, and they get a full pie chart of the different sector. You can buy a different, in each sector, but you never know which one's the one to buy, right? Financial has been defined, still, is it too late or not? I don't know. So that's why we like to make that possible, but good question. On this pyramid, the baseline are not managed, low cost, large index funds. The bigger the better because they can break the cost, right? But at the top, you want the smaller ones that charge higher fees, they're more manageable. But in the middle are the factor funds that are, multiple indexes, or factor funds that they buy all the non-tech stocks or all the tech stocks. They do everything passively organized and put into a bucket. And the top one,
Yeah, so here you can see the sector tracker that I usually use. It's sectorspdrs.com/sector tracker. And you can see the different performance on all these different time frames. They use their ETFs, which are all index ETFs for each different sector. So if you want to have exposure to different sectors, these are some options that you have. And you can see literally everything is up this year. There is nothing that's down. There's no poor performers. Except energy is only up 2%, but I didn't get in at the right time, obviously, because I'm still down 6. So, but you have all these different types of positions. And if we look at the month, we can look at what's been down. Energy's been down 6.3. Healthcare has been down 1.5. But yeah, this is just kind of an idea, a place where you can get an idea. And especially if you look at something like a 5-year, you can see what's up the least. Real estate. So that's one of the reasons why we would have gotten into there. Yeah.
So one,
Yeah, pretty much.
That's what we like, because if you buy one stock, they can go out of business, right? But a sector, if you buy it at the wrong time, usually you just wait it out, you'll come back. Generally, I'm saying on average at that point. But there are some funds. Can you explain what like JEPI is?
So that we're getting into some more specific things. So JEPI, which is a JP Morgan ETF, this is one of those derivative funds that we were talking about before. So this is one that basically the idea is they are taking some holdings from the S&P 500, then they're going to own those positions. And what they'll do is they'll sell call options on those positions. So a call option is basically when you write a call option, you're saying that you own 100 shares of a stock and you're basically selling somebody the ability to buy it at a certain price. And so if you have a stock at $50 and you say, I'm going to sell somebody the option to buy it at 55, so they're going to pay a little premium for that. And the person who's buying that hopes that your stock jumps a ton in value, and then they get to buy your stock at 55 plus the little bit of premium that they paid. And now maybe it's worth 60 or 70 or 80. And now they get to capture all of that difference immediately because their purchase price was 55 plus maybe $1 of premium, say 56. Now they can sell at 60 and they cash in $4 a profit. So that's kind of the idea there. So what JEPI is hoping to do is hold these underlying positions and continuously sell options that they hope will never be exercised or used, that they'll just expire worthless and the people who bought them will not have used them. And so they'll keep collecting little bits of premium. So that's one of those ways where you can still have some stock exposure, but really increase your yield. Now, the only thing about that is to understand that because you're limiting upside, but you're not limiting downside, you're only cushioning it by the yield that you're receiving. In a bear market, that's going to be a really poor, where it's going to be In a strong bear market, you're going to feel that full downside, but in a strong bull market, you're only going to feel a little bit because those positions are going to get called away by the options. But in a relatively stable market, or as a small position of your portfolio, you can generate some extra yield and push up your income numbers a little bit.
In a down market, that can help you build back the dividends, right?
Yeah, a little bit. So if it's going bearish, but the other problem with that though is those call options are going to become less and less expensive. So because they're not worth buying, who's going to buy a call option when the stock price is just tumbling? Those yields are going to drop a little bit. So it's one of those things that's kind of difficult to manage. And a lot of people like to actually just do this in their own portfolios. But yeah, it's kind of a particular use case sort of thing. I just use it to fatten up yields a little bit in small amounts. JEPI. Yes, it's an ETF. A quick little tidbit of information. If you want to know something is an ETF or a mutual fund, look at how many letters are in the symbol. Because if it's 4 or less, it's a stock or an ETF. If it's 5 letters, it's a mutual fund. That's just a fun little thing that I didn't think of.
The market falls, the value of the stocks will fall also, but you've got an 8 or 9 or 10%
Yeah.
dividend. And then just keep buying shit.
Yeah.
So when the market goes back up, some of the stocks will get bought away from you, so it's just a little hedge. The
Yeah.
best thing is just look at allocating several times within 5 years or so, and then decide, look, we can't say the market's not moving higher. I started when it was 800 in 1980, but at the same time, within the short term, you could say it's not going higher and it could just be smaller. So it'd be better to take some money out of the growth stocks and whatever and park it for a while. And if we're older anyway, so let's reallocate to some intermediate term treasuries or something. And hey, if it goes up, good for everybody else, good for the rest of my portfolio. Just look at your financial planning allocation and not think the market just keeps going up and up. It does not. And it should not. We don't want it to. We need a forest fire occasionally, right? And you're gonna get it. I just don't know what's gonna cause it. And so look at things right now and say, look, if we have a major decline, 2008, we had the market down 65% temporarily, then down 50%. That happens again. Could you have reallocated and prepared not just to avoid it, but then put money back in and that right now? Don't know what it is.
Yeah, and some
Right now, we can do highs consecutively every day, it seems like.
Absolutely, absolutely. And ask yourself, am I gonna be more upset if I got some money out, and missed out on the game, or if I didn't take any money out and it fell? Those are the 2 questions you gotta ask. And if you're more upset about the downside, then maybe some money off. You've already made your money. You've made all your profit. Do something somewhere. And maybe short-term or intermediate-term bonds or cash or pay out the house or whatever it is you want. But just remember, I don't know that it's going to keep consistently going up, but there's a lot of cash inside.
Yeah. Now, in regards to that JEPI fund, there's also the other side of that. So there's also, you can sell put options like on cash. So you could basically obligate that one where you sell it is like the idea, just the opposite, where you're buying the option to sell it at a different price. So you also have other funds that will sell put options versus the call options, where the call options is kind of more of a stable and slightly bearish strategy versus selling the put options is more of a stable and slightly bullish strategy. So you'll have other funds like PUTW, which is, I think, Wisdom Tree. I forget exactly what company it is, but they do the same thing, just in reverse. So you can kind of regard whether you think it's going to be bullish or bearish. Again, you're kind of taking a guess there, but you can kind of use those to strategically get a little bit more income in your portfolio.
You can read the fund. So you can buy the S&P 500 to find out, and they will take a little bit of a dividend yield or something if you puts. So they'll guarantee that the first 15% of the downturn, you won't lose any. But if it goes down 25, then you'll lose the next 5%, and so on. But it caps the upside. It's similar to one of these index annuities with insurance companies, but not original. They do it with the money of the fund. They're not taking advantage of you, but they're for the managed part of it. But if you think you're worried about the market, but you don't want to get out, you're not going to get as much on the upside, but you'll lessen the first 5, 10, 20%, depending on what you do.
So one thing you will have handed out to you is this little article from the SEC, which is their beginner's guide to asset allocation, diversification, and rebalancing, which basically just takes a lot of the stuff that we talked about and breaks it down into simple terms and is some things that are easy to understand, emphasizing things that I talked about like time horizon, risk tolerance, investment choices, and different things like that. So if you want to do any reading for homework, go right on ahead. And it's just good materials to have around. And a lot of the materials that we have and we pass out, good stuff to also just give to younger generations, just things for them to kind of get interested in it. And obviously, any of our stuff, we've always got extra books at the front of the class. So if you want to give them to anybody, feel free to take them. But that brings us to the end of our time today.